Good morning. It's raining in Madrid, finally, and I even decided to cut my hair today. But what really matters isn't the weather, it's the market. And today, I want to ask two simple but critical questions. First, can the S&P 500 continue to rise after the strong rally we've seen since last Friday? And second, what could derail this uptrend? Because after weeks of volatility, everyone wants to know, do the bulls still have fuel left in the tank? Let's start with market sentiment. Even though the S&P 500 is near the highs we saw around October 9th, the average investor sentiment is bearish. The CNN Fear and Greed Index is still showing fear. And if we look at the American Association of Individual Investors survey, bearish investors outnumber the bulls by more than 12 percentage points. Think about that. Despite the rally, most investors don't believe in it. Now, when everyone expects the market to fall, that's often when it doesn't. That's the contrarian principle. Markets climb a wall of worry. So, although we might see a small correction after yesterday's strong move, the most likely scenario, in my view, is that the S&P 500 still has room to go higher. You know, September is typically one of the weakest months for markets, and early October doesn't usually help either. Yet this year, the S&P 500 rose through both. And now, we're heading into one of the most seasonally bullish periods, November. Historically, November and December are positive months for equities, driven by optimism, corporate spending, and that famous Santa rally effect. So, from a seasonal standpoint, I believe the path of least resistance is still upward. Let's talk about one of the biggest drivers of this market, artificial intelligence. AI is not fading, it's strengthening. Google hit a new all-time high yesterday. Apple too. And if you look at the ETF that tracks the so-called Magnificent Seven, ticker symbol MAGS, it's back near its highs around 65.7. That tells me one thing: the leaders are still leading. This rally continues to be powered by AI and the tech giants behind it. As long as that sector maintains strength, the S&P 500 is likely to keep riding the wave. Now let's address one of the most misunderstood topics right now, liquidity. Yes, the Federal Reserve has reduced its balance sheet. Yes, some liquidity has been withdrawn from the system. But let's look at the facts. Even after the reductions, the Fed's assets remain far higher than they were before the pandemic. So yes, liquidity has been reduced, but not dramatically. And although the Treasury has also withdrawn some liquidity to rebuild its account at the Fed, that process has mostly finished. Now, the key point: the U.S. banking system still has $3.1 trillion in reserves at the Fed. That's a comfortable level. When I was studying economics, we were taught that banks should hold reserves equivalent to about 10 to 15% of GDP. Given the U.S. GDP is around 29 to 30 trillion, that means a healthy liquidity level would be roughly 3 trillion. So we're right there. In other words, there's no liquidity shortage. Until those reserves drop below a critical threshold, monetary stress shouldn't appear. So from a liquidity perspective, there's no ceiling for the market yet. That's why I expect the S&P 500, gold, and Bitcoin to keep trending upward. Now, something interesting and potentially worrying came from Donald Trump recently. He said, when liquidity returns, the U.S. economy will grow. That sounds positive, right? But let's interpret it carefully. If the new liquidity goes toward the real economy, to businesses, to production, to jobs, instead of Wall Street, that could mean slower growth for financial markets. When money moves from financial assets to the real economy, stock prices can plateau. So, when fiscal spending increases again, watch carefully. That could mark a potential market top. Now, let's talk about something that surprised many people: Powell's new stance on crypto. The Fed now allows banks to provide services to cryptocurrency companies and even conduct operations in that sector. That's a significant shift. The tone has softened, almost friendly. Combine that with stable liquidity, and you have an environment that's increasingly favorable for digital assets. Right now, both Bitcoin and Ethereum are moving sideways, consolidating. But if Bitcoin can break above that key level around 114, we could see the next big upward phase begin. So let's recap. Investor sentiment is bearish, a contrarian bullish signal. Seasonality is turning positive as we enter November. AI stocks remain strong. Liquidity in the U.S. banking system is still abundant. And crypto has room to run. From where I stand, there's still fuel left for the bulls. We might see corrections, we always do, but overall, the trend remains upward. And as long as liquidity and AI momentum stay in place, I believe the S&P 500, gold, and Bitcoin can continue to climb. That's all for today. It's starting to rain harder here in Madrid. Take care, trade wisely, and have a great day. If you want to keep learning about the markets with this kind of analysis, make sure to subscribe to the channel and hit the like button. It really helps more people discover this content and keeps me motivated to keep sharing these insights with you.